It is December 6th, 2022. This is Cowboy Metals Live. We broadcast every Tuesday night, 5:30 p.m. Central, 6:30 p.m. Eastern Standard Time, where we tell the truth and take no BS and broadcast from the great state of Texas. Thanks everybody for joining back in. Peter Froen, of course, for riding shotgun and doing moderator duties, and everybody else for putting up with the technical stuff that we had to. But we're back and we're going to talk bonds, and it's not going to change anything about the presentation. We're going to get through it. So I've been doing a lot of research on risk, and man, when I looked at the bond market and when I looked at the current headlines, it really kind of freaked me out. And I've talked about bonds some recently, but I felt like we needed a little bit deeper treatment on what's going on right now. So we're going to get into that. Also, I wanted to let you guys know it's all over Twitter, and we'll put a link out in the description of this video eventually as well. But I'm going to be speaking at Money, Metals, and Mines tomorrow morning about 10:05 p.m. Eastern Time. It's 9:05 p.m. Central Time. It's a free virtual conference, and I'll be talking about the mining industry and talking about mining stocks. For those of you interested in mining stocks, I'm going to talk about why I think that investment has to go up when gold and silver do, and a lot of data around that. So if you're interested in that area, please join, and that should be a pretty good presentation. And I might also eventually throw it up here on the channel later on as well. All right, but today we're talking bonds, and heck, I don't have time to redo the poll. So you guys just, in the chat, tell me where you think the bond market is. Is it frosty cool? And is everything going good? Is it warm? Is it hot? Is it blowing up? Is it on fire? Put in the comments where you think it is, and we'll talk about it during the stream. All right, without further ado, let's go ahead and get into it. I'm gonna see if we can do this without completely crashing the system. Zoom and YouTube, you guys, you can work okay. It's all right, don't worry. All right, here we go into the share screen, of course, into the presentation, which is called The Big Bond Fire. Everything burns, you just got to know what kind of fire to set. And we're going to be talking about what's going on in the bond markets. I got a lot of research for you guys. No worries about that. I think you're going to enjoy the presentation. Well, ladies and gentlemen, here comes the volatility. Why are we having volatility right now? Well, it's because everything is going crazy. Here's a quote from BlackRock Investment Institute research they just put out very recently on what's going on in the economy. And it says, the Great Moderation, the 4-decade period of largely stable activity and inflation, is now behind us. The new regime of greater macro and market volatility is playing out. And do we ever see that in bonds? According to BlackRock, from the same study, a deep recession is coming. They believe that GDP is running too hot. That's right. We have grown too far, too fast, as I've said many, many times for the last 12 to 13 years that I've been doing this. And here they're forecasting that GDP would have to fall 2% to tame inflation. That's right. Production would have to fall 2% to address supply chain issues, to develop imbalances in the economy overall. GDP has to fall to tame inflation. So we have a choice. Either we continue to run high inflation, or we detonate about 2% of the economy, including jobs, revenues, paychecks, everything along the way. That doesn't seem like the awfully best choice to me, but that's what these guys are saying. And I happen to believe their research. When you look at history, GDP is going to fall. That means recession, recession, recession is coming. Well, according to Bloomberg, we may already be on the precipice of a free fall. According to Bloomberg, a November 8th article, Wall Street alchemists turbocharge wild swings in the treasuries. And as Justina Lee and Liz Capo McCormick point out, there are structural positions embedded in this $24 trillion U.S. government bond market that could trigger unforeseen consequences, not unlike how liability-driven investment strategies help worsen the UK gilt sell-off. And that caused the UK Prime Minister to resign. So no small shakes there when we're talking about volatility and problems in the debt markets. Also from the article, you get through an inflection point and dealers have to buy volatility, said Veneer Bansali, founder of Longtail Alpha LLC and former head of analytics for portfolio management, Pacific Investment Management. He says, there's a lot of free stuff, or a lot of stuff that has happened that makes me believe that we're already on the precipice of a free fall. These structures just being a factor. That's from the news, ladies and gentlemen, not for me. This is all in the mainstream. And oh, wouldn't you know it, according to Bloomberg articles and article by Financial Advisor, corporate defaults are also coming. The S&P is now warning of $89 billion of distressed U.S. company bonds. That would be junk bonds, and they predict that an uptick in corporate junk bonds is coming, and that some 7.6% of U.S. low-grade bonds traded at least 1,000 points above treasuries in mid-October. That gap is widening, and it's not a good signal because it means financing for the higher risk companies, costs are going to go up even more than they are for everybody else right now. And more than likely, that will start a free fall in the junk bond market as they cannot get access to easy funding that they had before. And they're not going to have a lot of alternatives. Nobody has a lot of money to issue to basically firms that are trading at the junk level. And that is probably going to cause a cascading level of defaults. According to Financial Advisor, the S&P sees the U.S. corporate default rate more than doubling in a shallow recession. And that's not even the kind of recession we think is coming. We think it's going to be a real big, ugly, deep one. It says here the default rate for U.S. companies will soar to 3.75% if the Federal Reserve's fight against inflation only tips the economy into a shallow recession, according to S&P Global Ratings. A more serious downturn would send the rate to 6%. The pessimist case, though, remains a risk. A whopping 6% of high-yield corporate issuers could default, the highest since March 2021. If a deeper or longer recession occurs, the long-term average going back to 1981 stands at 4.1%. So the junk bond market is in trouble, and that means anybody dealing in junk bonds is in trouble. More defaults coming. Yeah, there are these things called junk bonds, and according to Jonathan Harris, an article at Schroders, what happens to high-yield bonds in times of market stress? Well, you can see on the chart at the right, it's not very good. They lost about 30% during the last crash. That would be the Great Recession. And if we have a recession as bad as that, I would expect that it would probably be just about the same thing. And it's not going to be pretty, ladies and gentlemen. That's not good. Now, the year following that, junk bonds tend to do okay. That's for the companies that don't get wiped out, by the way. That does not account for all the ones that go completely overboard. And also what happens is there are a lot of purchases by the banks and other big corporations of these companies for their IP and other things that are of value, equipment and things for pennies on the dollar when these companies default. It's not going to be pretty. That also means, ladies and gentlemen, we're going to have more job losses when companies go out. Those are companies right now that everybody thinks are doing okay, but maybe they won't after the next round of contagion and defaults, and they cannot get enough cheap money to keep going. And remember that I've said zombie companies as rated by the BIS. I've said several times this year in research by the BIS, we're sitting at an all-time high across the world for zombie companies. So that's defined as somebody that cannot continue without cheap and easy debt. They just can no longer do it. And they don't make money with their regular business. And not only are they at the highest level across the world they've ever been, but as well, the confidence factor the BIS has that these companies will actually recover is very, very, very low. I'm going to pop out of the presentation here for just a moment, and we will go back to the share in a moment. I want to check on the live stream and see how you guys are doing. How are you doing tonight? Ladies and gentlemen, thank you, Hugh, for the contribution. 𝙎𝙄𝙇𝘿, I did not see a question there. Please throw it in the chat if you have one, and I'll try to find it and answer it for you. Looks like everybody is doing well. We're at 155 concurrent viewers. We have sound, so we're going to go right back to that presentation, ladies and gentlemen, as we get deeper into it. And before we finish that, however, I do have a message for you. We have a preferred provider, and I'm going to show you the preferred provider that we use. My best investment since 2018, and this is a fact, by the way. I have come out and started talking about it, and that has been numismatic coins. What are numismatic coins, you ask? Well, I'm going to show you what they are. I have done better on this investment than I have done on any other. That includes my real estate and everything else. And I'm going to hold it up to the screen. The particular coin that we're going to talk about today is a 1904 gold double eagle. And that is an MS62 grade. That's a mint state 62. And that one has earned me quite a bit of money. We'll go look at the charts. The reason I buy numismatics is because they have collectible value above and beyond that of the bullion. And it has done very, very well. So let's get back into that. I happened to get mine through ITM Trading. You'll notice that Lynette Zhang was on the channel recently because she was, that's right, my very first video interview for this channel 4 years ago, where I flew out to Phoenix at their old ITM's old location. We had a great video that was on both of our channels. So I brought her back on recently because we just wanted to talk about what's going on, and because I wanted to help them gain more business for their numismatics. If you're interested, here you'll see the PCS price history. I gained about 67%, minus a little bit in fees that you pay when you buy and sell bullion, but just about 2/3 of my money on these coins. I had bought, I think, about 20 or so of these coins for around $1,500 mark and sold them for almost the $2,500 mark. Not quite all of them. I kept a few. As you see, I held one up to the screen, and we'll hold it back up to the screen again. This has, in fact, been my best investment over the last 4 years. Bullion gained about 27.5% because I sold one at 1658. Of course, bullion's up to 1800. So regular bullion has done pretty well, but the numismatics have done a lot better. You'll notice a link in the description if you guys are interested in helping out the channel and you're interested in numismatics. There's a Calendly link. You can sign up for a consultation with ITM Trading, or just call that phone number, which has a dedicated analyst that will be answering for you. Thank you, everybody, for tuning in to the program tonight, and we're going to continue. So what else do we know, ladies and gentlemen, about the bond market? Well, we know that banks are struggling with bad debt, as you can see here on an article from Bloomberg. This is no secret to anybody that's been following bonds, but why is this in particular bad? Well, according to Bloomberg, banks in the US and Europe are around 42, they're up to the 42 billion of buyout debt stuck on their balance sheets, and making the most of the last chance to get rid of this, or getting rid of a bunch of bad debt. Hung debt has become a big problem for Wall Street this year. You'll see at the bottom of the article. Banks have taken huge mark-to-market losses on deals they underwrote before a rapid rise in interest rates crushed funding markets, and the threat of recession quashed investor demand for riskier assets. Why are these riskier assets? Well, we're talking about bad debt. We're talking about junk debt. We're talking about debt from companies that went under. Maybe they weren't a zombie company, but they had, the pandemic may have taken out a restaurant or something along those lines. And that debt is starting to add up big time, and the banks are struggling. Now, this could cause a daisy chain or a domino effect on the bank's balance sheets. If it gets bad enough, it could put a bank out, and one bank could cause stress on the system and cause more to go out. And that's what we're talking about here. When the banks start struggling with bad debt, we're looking at debt contagion. We're looking at how bad can that spread to the rest of the economy? How bad is it going to get? And guess what? There's no help from the new kids on the block. The emerging market corporate debt market is in disarray as well, flashing a risky signal, according to Swiss Info. In an article from Bloomberg, debt markets are signaling a widening gap between emerging market corporate borrowers and their sovereign peers. While risk premiums on corporate and sovereign emerging market debt were similar at the start of 2022, investors are now demanding 72 basis points more from corporate issuers in the emerging market, according to Bloomberg. The cost of raising new debt is prohibitive for many firms, shutting them off of the market. Again, junk bonds not doing so well, overall corporate debt not doing so well, sovereign debt we'll see, and emerging markets are not doing well either. Nobody's doing particularly well in this market. It's all over the place. And the market doesn't know that the damage is coming. The market doesn't know, ladies and gentlemen, that the damage is coming. According to BlackRock, in that same presentation I mentioned at the beginning, look at the highlighting here on the left. We are here. We're in a place where the risk is there, but the damage is not priced in. The market does not know the damage that is coming. It is not priced it in. Prices do not reflect that in the bonds or the stocks or anywhere. It's not priced in. BlackRock is a big investor. A lot of money. They know the market, and it's not priced in yet. But we know the risk. What is the risk, ladies and gentlemen? Well, look at the US Treasury market. Look how much it has grown since 1990 on the chart on the left. Thank you to SIFMA and New Capital Management for the data that we have on the screen. But liquidity has been evaporating because the market has grown so much. Liquidity, however, the ability to finance operations on a short-term basis, that liquidity has started to fall. There are reasons for this. It's based on type of issuance and how that market works, but it's not there. Therefore, the Treasury market volatility has been rising. Ruh-roh, Shaggy, what are we going to do now? The ICE Bank of America Move Index tracks implied volatility for the options and swap markets. And it's gone way the hell up. And you'll notice on this chart on the bottom middle that volatility rose during the initial stages of the COVID pandemic that was called by the government and the media using their terminology. But it spiked and came back down. But look at what has happened since the beginning of 2021. The last year and 3 quarters, Treasury market volatility has gotten worse. Why has it gotten worse? I don't know. If you look in the upper right-hand corner, thank you, SIFMA, we see that corporate bonds, mortgage-backed securities, asset-backed securities, Treasury securities of the U.S. government, municipal securities, and a couple other types of securities that are at risk, according to research from BlackRock and the banks and everyone else, $53 trillion, ladies and gentlemen. We know the risk. The market has not priced in this risk. Look at where we are now. Damage is not priced in. That's a $53 trillion market, ladies and gentlemen. That is a $53 trillion market, ladies and gentlemen. We know the risk. The question is, will Rome burn again? On the right-hand side, we had Rome burning, the fire that put Nero and Rome finally out. And on the left, we have the first burning of buildings by British soldiers on U.S. soil. Will we burn again? Will we survive, or will we burn? What will be the answer, ladies and gentlemen? What will happen? I think if the bond market goes down, it's very likely, it is very, very likely that all the financial markets go down. And it's very, very likely that the government institutions can operate, that corporates can operate, that we can all operate like normal when that happens. Will it all burn down and be rebuilt? Will it be temporary crisis, long-term crisis? That's what we're trying to figure out. And I will have some predictions on that if you watch Rob Kientz Unfiltered. And that's a nice segue into our membership service, ladies and gentlemen. Since you watch us on the channel, and if you'd like to support us, we have 2 levels of membership. The first level is just supporting us for the content that we do for you for free on the channel. And it is a nice thank you. It is not required, but definitely helps out the channel. If you join at the second membership tier, you can access Rob Kientz Unfiltered. That is where every 2 weeks I put out a video that talks about my predictions and my deepest thoughts about what is going on. We put that there because it's a nice little community of people who want to know the deepest of truths. The free channel basically gives you all the research and information, but here in Unfiltered, we talk about what I think is going to happen. And I'll give you my predictions there first before you will see them anywhere else. And that is for people that do support the channel. And if you have been supporting the channel, thank you very much. I'd like to thank everybody for joining tonight. That's almost going to wrap it up. The bond market is starting to burst into flames. I think that we are in bad straits. I think it's going to get worse before it gets better. And I think we're going to start talking in 2023 about bank failures. We're going to start talking about systemic risk, much like we did in 2008 during the height of the buildup of the Lehman crisis, and then February 2009, which was the absolute worst of that crisis before it got better. And that was also the period of time in which I lost the only job I have ever lost. I was not fired. I was laid off because my firm could no longer afford to keep me. And I remember those times. And that's why we talk about these times, once again, ladies and gentlemen, is to help you guys prepare, because I think we're headed for the exact same thing, but I think it's going to be quite a bit worse. And I think we saw the numbers in the presentation, and that will tell you why. Thank you so much, everybody, for joining. Remember, if you're interested in numismatic coins, Rob's best investment since 2018, ITM Trading, there is a link below in the description, and we put it up on the presentation. And thank you, everybody, for supporting the channel. Until next time, this is Rob Kientz, Gold, Silver Pros, Cowboys, Metals Live. We're broadcasting from a great state of Texas, and we take no BS.